Welcome to Course 3, Unit 2, Lesson 2 Practical Exercise for Return on Equity. Okay, so on the video above on the Buffett's Books website, I just got done teaching you a lesson on return on equity. And so I want to give you a practical exercise of a company that's out there right now that is a great example of something you might want to avoid, even though it might have all really good signs, but it's a perfect case to show you why return on equity is so important. So the company that I'm going to demonstrate this with is the CME Group. And this company is somewhat of a holding company. They're involved in a lot of different business sectors. And so what I'm going to do is I'm going to break down the numbers for you and show how this might look as a really great pick, but at the end of the day, it's going to produce a lot lower numbers than what you might anticipate. And we're going to use the Buffett's Books Intrinsic Value Calculator to help you determine that. Okay, so when we first look at this company, I'm just going to go through some of the basic metrics that we'd be looking at to get us started. And the first thing that I really kind of see as I look at the company is you're going to see the market price there for $262. The dividend rate is $8.92, which gives you a 3.39% yield based off of that current market price. So it's paying a 3.3% dividend. As we go down, I'm obviously looking at that debt number. The debt to equity is really low. That's a great number at 0.1. That means this company has hardly no debt at all. Their earnings at $24.39 is decent. That's not a bad EPS. When we look at the PE, it's at 10, which is also good. So all these numbers are looking really good. So let's go ahead and look at how this company has grown its book value through the last 10 years. Because we know that that's extremely important to see the trend. So we're going to go to Key Ratios, 10-year summary. And as we come down and look at the book value, we can see that 10 years ago, the book value was $13, $17, $23, $32, and it goes clear up to $325.09, which is an enormous book value. And when we look at the trading price of $262, that's significantly lower than that book value. So right off the bat, a person that would see a company that's grown at this book value at that rate would be very enticed by a company like this, especially at its trading price. It's got positive earnings and all those things. So let's go in here and look at the earnings growth that we could see. Okay, so for 2013, they are suggesting that the earnings are going to be, and this is covered by 16 different analysts, the average between those analysts is saying that for 2013 it's going to be $18.88. Okay? So this is the perfect return on equity company that I'm going to use to demonstrate why you're not going to get as big of a return out of this company as you might think just by looking at those pure numbers and using that basic Course 2 type analysis. So this is really the art of security analysis, is getting in here and understanding this kind of stuff. So what I'm going to do is I'm going to go ahead and pull up the intrinsic value calculator off the Buffett's Books website. So if you go to the top level page here on the Buffett's Books website and you go to intrinsic value, okay, so it takes you to our intrinsic value calculator. And the great thing with the calculator, and this is a perfect example why I don't just provide a tool where you input the ticker and it spits out the intrinsic value is $50 or $100 or whatever. Because in order to do this properly, you really have to put a lot of thought into each one of these companies. This isn't something that a calculator or a programmed Excel sheet can really solve for you. You have to get in there and really do some analysis. So this is how I would do the analysis on a company like this in order to kind of pick it apart. So my initial assumption on this company is that it's not going to have a good return on equity because it has such a high book value. The book value is up in the $300 range. And as we look at these projected earnings, it's only going to make $18. So right off the bat, I know I'm around a 5 or 6% return on this company if they retain all their equities and the company would trade at its book value. Now the company is trading below its book value, which is going to give me a little bit of a higher return. So the typical person, the person in that intermediate phase would probably value the company like this. Okay, now this is the wrong way to value it, but I'm going to show you how the intermediate person might go about this. Just based off of those tools that they learned in Course 2, they would go over here and they'd look at they'd first look at the key ratios. Okay, so they'd pull that up and they would go to the 10-year summary and they'd look at this book value growth and they would be really excited because the company's just got a ton of book value. So they go here to the current book value and they'd put in $325.09 or 90 cents. Okay. The old book value, they'd look at it and say, well, it grew from $13.71. Okay. And the number of years between that is 9 years. So they'd hit calculate and they'd see that the average book value change was 42%. Okay. Which is massive. This company had massive growth. Okay. With 42% annually. And the thing you've got to realize is anytime you see something that's like over 15%, that's a company that's not in a steady state position. Okay. When we look at how much the company's grown since 2007, that's going to give us a much more realistic book value growth. So this is how I would value this company. This number that right here, this book value growth, I would completely just throw it out. I wouldn't even use that. Okay. And what I'm going to do is I'm going to give this company the benefit of the doubt. And I'm going to assume that they retain all of their future earnings that are currently projected at $18 a share. Okay? So how I do this is I come down to the second calculator. I completely discount that first calculator. I don't even want to know what the book value is because it's so unstable and unrealistic that it can't be obtained, in my personal opinion. Okay? So this is my more conservative estimate of what this company would be worth. So the cash that can be taken out of the business, this is typically the dividend. And what I'm going to do is I'm just going to list all of the EPS as a dividend, just so I can get an idea of what this company is going to be worth. And then I'm going to put nothing in the book value growth. I'm just going to put all the growth straight into the dividend. So as you remember, when we looked at the earnings forecast here, it was for $18.88. So I go up here to the dividend payment, which is the cash that can be taken out of the business, and we're just going to assume that all of that cash can be taken out of that company at $18.88. Okay? So we have that in there, and then the current book value, if you remember, it was $325. Now I'm going to go to the recent quarter here, which I can pull from the financial highlights, which is $325.53. Okay? So that's our current book value, $325.53. Okay? Okay, so that's in there. Now our average percent change in book value, we already said we're going to use 0 because we're going to assume all of the earnings are just going to be paid to us as a dividend. Okay? Now that's not going to happen, but that's how we can value the company with this particular calculator. Okay, so the number of years, we're still going to use a 10-year rate, and the 10-year federal note is around 1.5 right now, so we're going to put that in, and it's going to calculate our intrinsic value. Okay, so if this company traded at $454.60, we could expect a 1.5% return. Now, the company's trading at a much better rate than that at $262.05. Okay, so in order to figure out what kind of return we could expect to get from this company, let's go ahead and change this number to 7%. Okay, and now we're getting close. I came down to 298. Let's put in 8%. 277. So we're getting closer. Go ahead and put in 9%. Okay, so it's around 8.5%. Okay, now before you get all excited thinking that you can buy this company and expect an 8.5% return, you've got to realize that that is assuming that all of the future earnings, if the earnings remain constant at $18.88 a share for the next 10 years each year, if all those earnings are retained into the business, into the company's book value, okay, you're going to make an 8.5% return. Can the company do that? Probably not. They're going to probably be a little bit lower than that. They're probably going to be below that $18 figure. Now, they might be above it, they might be below it, but that's the current assessment that I would give this company. Now, a person who wouldn't necessarily take note of that return on equity is going to come up with a much, much higher estimate than 8.5%. They're probably going to have something that's like way up in the 20 or 30% range, which is not realistic at this point. And it's not realistic because the company's book value is so high and their earnings are so low relative to that book value. They can't grow it that fast. They need an EPS of like 30 or 40 in order to continue growing at the rate that they've grown in the past. Actually, they'd even need more than that. So I hope that this gives you a good idea of how you really can't just simply spit numbers into this calculator. You really got to do some assessment. So if you remember when we first put the current book and the old book in here, and we got something like a 40% change in the book value per year, If we would have just gone straight down to the second calculator and started using those numbers, let's go ahead and put a 40% growth in here. And let's put the real dividend in that the company has, which was $8.92. Okay, and the current book is that, and we'll put the 10-year federal note at 1.5. You can see that the number is just ridiculous. It's at 8,195, and in order to get your expected return, I'm sure it's going to be something like that. Yeah, that's even not high enough. It's like 50%. These numbers don't even make sense. Now, the easiest way to identify when this calculator isn't going to work for you is as soon as you get into something that just has growth that's like above 15 or 20%, you're not dealing with a value-based company, you're dealing with a growth company. And so you can see some of the techniques I use to try to value that growth company if you'd ever really still be kind of bent on buying something like this. You got to be real careful that you're not just pumping numbers in here from past performance and expect that to be your future returns on this company. So my assessment for CME is that I think that you'll get a 7 to 8% return at the current market price of $262.05.